Silver vaults in Shanghai, glowing under industrial floodlights, stacks disappearing faster than the cameras can log the serial codes. While you watch the price surge to $90 in January 2026, and then collapse back to the mid-80s, a nation-state accumulation protocol was running in the fine print. The metal you were told was a $50 relic just shattered a 50-year ceiling. It didn't go back. You see, the floor of the new reality is the ceiling of the old one. Most people believe silver is a volatile industrial commodity. A metal that peaked in 1980 at $50 crashed and has spent 5 decades trapped in a cycle between $4 and $50. The narrative you have been sold is simple. Silver is too unstable to be a store of wealth. It's for day traders and conspiracy theorists. But here is what the data shows. Silver was the only major commodity held below its 1980 high for 50 consecutive years. Not oil, not copper, not gold. This was not a market cycle. This was a compression. And compressions don't fade, they release. The mathematical sequence began on January 6, 2026. Silver breached $92 per ounce. The Hunt brothers' nominal high from 1980 was finally erased. Then came the correction, a gut-wrenching drop to $83. The media called it a crash. The forensic file calls it a shakeout pattern identical to 1979 and 2010. This file uncovers the Shanghai premium proving physical silver has detached from the paper price. The Reserve Bank of India remonetization directive legalizing silver as formal collateral for 1,400,000,000 people, and the China export licensing framework trapping 70% of refined supply inside their borders for solar and AI production. The math is no longer theoretical. Clinical disclaimer. This is not financial advice. I am not a licensed advisor. Your capital is your responsibility. Always conduct your own research. The first crack in the official narrative appeared on February 4th, 2026. Shanghai silver on the Shanghai Gold Exchange closed at $93.10 per ounce. COMEX in New York quoted $89.90, a $30 premium. You see, when physical metal trades at a premium to the paper contract, it signals one of two conditions. Either the paper market has lost credibility, or the physical supply has become strategically constrained. In this case, it's both. The Shanghai Gold Exchange is not a speculative derivatives market. It is a physical settlement exchange, which means every contract must be backed by actual metal in certified vaults. No rehypothecation, no fractional reserves. The result is a real-time price discovery mechanism for physical demand, and that demand is coming from Chinese industrial buyers who cannot wait for COMEX delivery schedules. China controls 80 to 90% of global solar cell production. Each gigawatt of solar capacity requires approximately 32 metric tons of silver. Plus, the artificial intelligence server farms now being constructed across Shenzhen and Beijing require silver-based thermal interface materials and high-frequency circuit boards. The metal is not being hoarded. It is being consumed, which means the premium you are seeing in Shanghai is not a temporary arbitrage opportunity. It is a structural shift. Your COMEX price is a quote for future delivery. The Shanghai price is the cost of metal you can load onto a truck today. The gap between those two numbers is the gap between theory and reality. If this specific mechanism just clicked for you, or you want to track these forensic shifts as they happen, join the circle by hitting subscribe. The data does not wait for permission. But even this $30 premium is a distraction from the legal framework that just went live on April 1st, 2026, a framework that allows 1,400,000,000 people to walk into a bank, pledge 10 kilograms of silver, and walk out with formal credit. The Reserve Bank of India just remonetized silver, and the execution codes are already running. April 1st, 2026, the Reserve Bank of India published a directive most analysts ignored, Reserve Bank of India Directions 2025, effective immediately. Borrowers in India can now pledge up to 10 kilograms of silver as formal collateral for bank loans. You see, this is not a policy tweak, this is remonetization. For the first time in modern history, silver has been recognized as Tier 1 collateral by a central bank governing 1,400,000,000 people. Not as a commodity, not as jewelry, as money. The directive allows any individual or small business to walk into a regulated bank, pledge physical silver, and receive formal credit against that metal at a 10-to-1 ratio relative to gold collateral. Which means the Indian financial system has just assigned silver an official monetary value. The execution began within 48 hours of the directive going live. Rural lending institutions across Maharashtra, Gujarat, and Rajasthan began accepting silver bars and coins as loan security. The typical loan structure is straightforward. 10 kilograms of silver at $90 per ounce equals approximately $29,000 in collateral value. The bank issues a loan at 70% loan to value, approximately $20,000 in rupee-denominated credit. But here is the black magic buried in the fine print. The borrower does not sell the silver. The silver remains the borrower's property, which means if the price of silver rises, the borrower can request a collateral revaluation and unlock additional credit without selling the underlying asset. This is the exact mechanism that drove gold's acceptance as reserve collateral in 1971. The result is a feedback loop. Demand for silver as collateral increases the price. The higher price increases the borrowing capacity. The increased borrowing capacity creates more demand for silver. India is the second largest silver consumer on the planet. The country imported approximately 6,000 metric tons of silver in 2024 alone. Now, every gram of that imported metal can function as credit leverage inside the banking system. You see, when a central bank recognizes an asset as formal collateral, it is issuing a floor guarantee. The RBI has just told 1,400,000,000 people that silver is no longer a speculative metal. It is a monetary instrument. And monetary instruments do not trade at $50 per ounce when the collateral system is expanding. But the Indian directive is only half the sequence. The second catalyst went live on January 1st, 2026. China implemented a mandatory export licensing framework for all silver shipments. Only 44 state-certified firms are now authorized to export refined silver from Chinese territory. Every other refiner, recycler, and distributor has been locked out of the global market. The Export Control Law of the People's Republic of China, revised January 2026, now classifies silver as a strategically controlled material. The justification cited in the regulatory text is industrial security. Silver is required for photovoltaic solar cells, high-frequency semiconductors, and thermal management systems in AI server infrastructure. China controls 80 to 90% of global solar cell production. They are not exporting the metal that powers that monopoly. China refined approximately 4,000 metric tons of silver in 2025. Under the old framework, 60 to 70% of that output was exported to European fabricators, Indian jewelry manufacturers, and North American mints. Under the new licensing rules, that flow has been severed. The metal is being diverted to domestic industrial consumption, which means 60 to 70% of globally traded refined silver just vanished from the market. Not because of a mine collapse, not because of a strike, because a government flipped a switch. On January 1st, 2026, hours after the export licensing rules were published, Elon Musk posted a reaction on X, quote, "This is not good. Silver is needed in many industrial processes." You see, Musk does not comment on commodity markets. He comments on supply chain vulnerabilities that threaten Tesla's production timelines and SpaceX's satellite infrastructure. Both require silver-based conductive pastes and thermal interface materials. The fact that he broke his silence on this specific regulation tells you the industrial buyers are already feeling the supply constriction. The combination of these two catalysts creates a price trap. India is pulling physical silver into the collateral system. China is trapping refined supply inside their borders, which means the available pool of metal for Western investors, industrial buyers, and sovereign mints is shrinking in real time. Your COMEX futures contract is a promise to deliver metal, but if the metal is locked in Indian vaults as loan collateral or consumed in Chinese solar fabs, that promise becomes mathematical fiction. This is why the Shanghai premium exists. The $30 gap between COMEX and Shanghai is not an arbitrage error. It is the price of certainty. Shanghai traders are paying a premium because they know the metal will actually arrive. COMEX traders are paying a discount because they are betting on a delivery system that is running out of inventory. The sequence is already in motion. India remonetized silver on April 1st. China locked the export doors on January 1st. And while the Western financial media was distracted by the January correction from $92 to $83, the structural floor was being poured. The global silver market ran a cumulative deficit of 796 million ounces between 2021 and 2025. That is nearly a full year of total global mine production. The 2025 deficit alone was 149 million ounces, which means the market has been consuming more silver than it produces for 5 consecutive years. And now the two largest consumers on the planet have simultaneously restricted supply and turbocharged demand. You see, the math does not care about sentiment. It does not care about corrections. It does not care about headlines. The math dictates that when supply contracts and monetary demand expands, the price must adjust. The India-China supply trap is only one layer of the 2026 maturity wall. The second layer involves the commercial real estate debt cliff and the Federal Reserve's collateral crisis. I am writing a full forensic autopsy on that mechanism right now. Make sure you are subscribed so you do not miss the reveal when it drops. The execution codes are already running. But before we can understand why this sequence is inevitable, You need to see the historical script, because this is not the first time a strategic metal was trapped by empire competition. Spain did it with gold in 1597, Britain did it with sterling in 1931, and in every case, the empire that controlled the collateral system controlled the next century. The pattern is mathematical. History is not repeating, it is rhyming, and the rhythm is mathematical. There is a 7-stage collapse pattern that has destroyed every major empire in recorded history. Spain in the 1590s, Britain in the 1900s, the Soviet Union in the 1980s. The United States is currently at stage 5. In 1597, the Spanish Empire controlled the largest silver mines on the planet, Potosí in modern-day Bolivia, Zacatecas in Mexico. They extracted approximately 45,000 metric tons of silver between 1500 and 1600. The metal flooded European markets. Spain used it to finance wars, build cathedrals, and maintain the largest naval fleet in the world. But you see, they made a fatal error. They confused resource extraction with wealth creation. By 1600, Spanish silver production had peaked. The easy veins were exhausted. Labor costs skyrocketed. Refining infrastructure collapsed. Meanwhile, the Dutch and the British had built financial systems that allowed them to leverage credit without needing to mine metal. Spain had the silver. But Britain controlled the collateral system, which means Spain's resource advantage became irrelevant the moment their competitors financialized the metal. The empire that controlled the collateral framework controlled the next century. The United States is running the Spanish script in reverse. America does not control the mines. China, Peru, and Mexico produce 70% of global silver. America does not control the refineries. China refines more silver than the next 3 countries combined. And now, America does not control the collateral system. India just remonetized silver. China just locked the export doors. The resource advantage has shifted. Fast forward to 1931. Britain had been the global reserve currency for over 2 centuries. The pound sterling was backed by gold. Every major trade settlement was priced in pounds. But the math was breaking. Britain's gold reserves were draining. The country had financed World War I by printing currency far in excess of its metal backing. By September 1931, the Bank of England held only £130 million in gold reserves against £750 million in circulating notes. The ratio was unsustainable. On September 21st, 1931, Britain abandoned the gold standard. The pound collapsed 25% within 6 months, and the global reserve currency shifted, not immediately to the dollar, but the process had begun. You see, the moment a reserve currency breaks its commodity backing, it enters a terminal phase. It may take 5 years, it may take 15 years, but the sequence is inevitable. The United States officially severed the dollar's link to gold on August 15, 1971. President Nixon closed the gold window. At that time, the U.S. money supply, measured as M2, was approximately $600 billion. Today, M2 stands at $21 trillion. That is a 35-fold increase in 55 years, which means every dollar in circulation in 1971 is now worth approximately 3 cents in purchasing power. In 1980, silver hit $50 per ounce. The Hunt brothers had cornered the market. They had accumulated over 200 million ounces. The Federal Reserve intervened. Margin requirements were raised. The Hunts were forced to liquidate. Silver crashed from $50 to $10 in 3 months. And for the next 45 years, silver never reclaimed that high. Not in nominal terms. But here is the forensic data the media does not cover. If you adjust the 1980 peak for M2 money supply expansion, $50 in 1980 is equivalent to approximately $590 today. Silver is currently trading at $81, which means silver is 11.8 times below its inflation-adjusted high relative to monetary creation. You see, this is not a bull market, this is a reversion. And the reversion is being accelerated by a supply crisis that has no historical precedent. Between 2021 and 2025, the global silver market ran a cumulative deficit of 796 million ounces. That is nearly 1 full year of total global mine production. The 2025 deficit alone was 149 million ounces, which means for 5 consecutive years, the world consumed more silver than it produced. This is not a cyclical imbalance. This is structural depletion. Silver does not move in smooth, predictable curves. It moves in violent, parabolic surges. 1979 to 1980, silver went from $12 to $50 in 5 months. 2010 to 2011, silver went from $18 to $50 in 7 months. Both moves were driven by a combination of monetary fear and industrial demand. Both were followed by brutal corrections that shook out weak hands. And both established new structural floors. In December 2025, JP Morgan issued a research note projecting gold to reach $8,500 per ounce by late 2026. If gold hits $8,500 and silver reverts to its historical ratio of 60 to 1, silver reaches $141. But you see, the historical ratio is conservative. During monetary crises, silver outperforms gold. In 1980, the gold to silver ratio compressed to 17 to 1. If that ratio repeats at $8,500 gold, silver hits $500. That is not speculation. That is math. Most people will dismiss this data. They will say silver is too volatile. They will say the system is too big to fail. But you see, we are not most people. We are the ones who read the fine print. We are the ones who track the vault inventories. We are the ones who see the execution codes before they run. And the codes are running right now. The singular truth buried in every imperial collapse is this: the empire that controls the collateral system controls the next century. Spain lost control of silver in 1600. Britain lost control of gold in 1931. And the United States is losing control of both in 2026. India remonetized silver. China locked the supply. The BRICS nations are building a commodity-backed settlement system. The Western financial system is no longer the only game, which means that the assets that the new system values will reprice violently. But the India-China trap is only the surface layer. The deeper mechanism involves the commercial real estate maturity wall, the Federal Reserve's collateral crisis, and the mathematical deadline embedded in the Treasury's refinancing schedule. That autopsy is coming. The floor is no longer $50, the ceiling is no longer capped, and the math does not negotiate. Most people will ignore this data and pay the price. They will wait for the mainstream media to confirm what we already see in the vault inventories and the export licenses. But you see, by the time the confirmation arrives, the metal will already be locked inside collateral systems you cannot access. If you are the type of person who refuses to be a victim of the 2026 script, join the forensic circle by hitting subscribe. We do not wait for permission. We read the execution codes before they run. The India-China supply trap is only one layer of the 2026 maturity wall. The second layer involves $38 trillion in U.S. debt that must be refinanced between now and December. The Federal Reserve's collateral crisis. The commercial real estate cliff. The Treasury's liquidity trap. I'm writing a full autopsy on that mechanism right now. Make sure you're subscribed so you do not miss the reveal when it drops. The math does not negotiate. Silver was trapped for 50 years. It shattered the ceiling. It did not go back. The floor of the new reality is the ceiling of the old one. As of February 9th, 2026, silver spot closed at $81.13 per ounce, up 5.51% on the day. Gold reclaimed the $5,000 threshold. The sequence is in motion. The empires that controlled the collateral system controlled the next century, and the collateral system just changed hands.